Welcome to StockMarketPending.com. It happens to be a Saturday morning, a good Saturday morning. Date 4/24/2010, 9:39 a.m. Pacific Standard Time. And basically, we meet here every Saturday morning at 7 o'clock with our SMF Pro Trading students. And what we're going to do is we're going to talk about the cycle move as an update of what the 10-year history was back where I said it would go on those tapes, and now you can see we're there. That's the beautiful thing about having a follow-up. So what we're going to talk about is the history. We'll start with the monthly chart of the Dow. Back here, we had a correction. We had a stimulant program that had hit back in, remember when people were back here in the Gulf War. And we went up and we fell. Then we had another expansion that came in at the bottom of 2002 with Greenspan's low interest rates and everything that was going on during this era. And we had another expansion that lasted. And it was a stimulant that we were in a recession. It was shallow. They over-steroided the economy. Then we had the housing bubble that happened up here. But my point of it is that the expansion failed, gave it all back. And basically what I want people to know on this particular tape is that there are lots of things that go on economically, history-wise, and bubbles, exuberance, and everything that goes on in these moves. The thing that I want you to know is that they have failed. They failed here, they failed there. Two failures. This was a tech bubble, but this is a Dow and it's only 30 charts. Now, we went straight down and we winded the tape up with the belief that we're going to have the big V-shaped recovery. Well, what StockMarketFunding.com is going to show you is half of that monthly bar is that V right there as far as the Dow goes. Let me tell you what happens with V-shaped recoveries. There's always, to any V, forward looking out, there's one of these that go with the V. So here is a V. There it is there. There it is there. And we can potentially go right up there. But then the other side of the V is that. What this leg going into the second half of the year, or particularly 2011, 2012, is that these cycle events just don't happen overnight or just in a few months. They're trying to bring the Dow back up to a buy signal like they did here when they did all that stimuluses back in 2002 off of the bear market lows. And they popped it to a buy signal, and they're running this one direction here. This low reading on this monthly MACD is where the negative part was, where people should be buying before it ever potentially creates a monthly buy signal. Monthly buy and sell signals only come around every so many years. Could be 4, 5, 6 years. In the last case in some of these, they were 6 years between buys and sell signals. And expansionary economies and expansionary earnings and where we're at today is not like it was. And this is going clear back to 1970. Here's what was happening in 1972. We went down, we went up, and we went sideways, and we went sideways. As an example of all of this is that we know that higher taxes are coming, and we know that the core fundamental of the country has changed because of the amount of steroids that we have put into this system is more than any other time. The TARP, all of the news that you've been following over the last couple of years. What happens with stock markets in general is that the stimuluses are working all the way up, just like the failure was working on the way down. And the stimuluses come in here and we're coming all the way up here. What I will be telling people is that international fund managers have been coming off the sidelines and coming into the U.S. markets and driving this 3-month trend up. So what started over here back in March, we called the very bottom. We were in this and we called the bottom before we got here, and we bought that and we gone up. And then here's the correction in January. Now, let me tell you about something here. This is a second leg or potential second leg of this 3 month up move from that uh, double top in January and we came down. It's a second leg to this long bottom leg when we were down here really oversold when the financial crisis was at its worst point. This is a second move, an attempted move to go higher. The thing about the whole move is that the consumer forward looking, where taxes, inflation, and everything forward looking. Remember, this is April of 2010. But what you see and where we're going to be at the end of 2010 going into 2011, 2011 is where we would see this mathematical, so we went mathematical range all the way down from there to here. This is another area from there to there. Here's a potential top. This is the near term top. This is a half of a monthly correction bar that happened on 8/1 of 2008. We went straight down. And what I'm telling people is this is a secondary leg that people need to be very leery of. On a monthly chart, on a percent DS, is that we can go higher because more people are coming off the sideline to push that higher. But we are going to reach a point where we're too overbought. And what's going to end up happening here is that we're going to have another correction. Corrections have various phases. What you want to do, if you have an IRA or a 401k or investments, most people are not even involved in this move. Really, even less people are involved here than what was here. Because as the markets go up, Main Street gets more resentful. And mathematically you go down and mathematically you go up in both directions. But there's a big disconnect. There's a big disconnect between forward-looking sustainability of growth compared to how the re-leveraging up versus the deleveraging down. Remember that the deleveraging down effect was created by a lot of havoc in the financial world or within the financial system themselves. And the problem is that the government's going to keep rates too low. We're going to go up higher. Inflation's going to have a problem. Taxes are going higher in 2011. We're going to hit a top, and this is where there is the first leg up, first leg down, first leg up with the continuation of right. But there's a third leg that comes in the market. What I will tell people is as we move forward, the more overbought we get, we'll have the smaller corrections. They could be anywhere from 6 to 10% between now and year end when we get in the too overbought cycle. The third leg down is another leg like this. You mathematically go down, you mathematically go up. What I want people to know is that you do not want to get caught in that leg down. That will be coming. You will have some smaller corrections as we top out up in here. That's not that far to go. That's that monthly correction bar right there. Half of the SMF monthly bar. And what I want people to know is do not be another victim going into year end or second half of the year. Particularly, let's talk about 2011 and 2012. 2011, 2012, but particularly 2011 is where this next leg down starts. It's called the third leg.